welcome everyone. Thank you for joining us. Without further ado, it is my pleasure to introduce Michael Paulenoff, founder of MPTrader.com. And to our live viewers, please, if you have any questions, you can address them to Michael by emailing him. With that said, I will be right here if you need anything, Michael. The floor is all yours.
Thank you very much. Hi, everyone. It's been a long day. I don't know about for you, but for me, it has. Building the anticipation to this crazy rate cut, 25.50 and all that stuff. It's finally behind us, and we'll discuss that a little bit to see if what exactly or what we can look forward to. Now the big event. The next big event is the election. And so we have 6 weeks, and basically the Fed, with 50 basis points, poured kerosene on the equity market. And if don't fight the Fed means anything, then it's the Fed getting on steroids ahead of the election. But the market didn't react quite that way today. We'll discuss that in a minute. Anyway, what you're looking at on the screen, I hope, is the front page of my website. And in lieu of my camera, which I'm going to have to figure out why it malfunctioned, this is me. So you need to visualize somebody actually talking to you. You can visualize this person right here. This is my website, mptrader.com, and I'll briefly describe what I do. We're going into our 23rd year, and I've been doing this a long time, and this is like a second career for me. I started in the early 1980s on Wall Street in research, and then in trading, foreign exchange trading, and then in commodity trading and equity trading. So I've kind of been a research quasi sales trader, analyst trader for my entire career. And I started in 1980, right at the top of the commodity market, and I watched commodities go down for about 3 decades. So I'm pretty versed in commodities, and which was right at the top. And the bond market, that is, yields topped out in 1980 also. So I spent 30 years, actually 40 years, watching yields go down. So I've seen a lot of different markets, and some of those markets, in particular the two I just mentioned, look like they're making or in the process of making 40-year lows. However, okay, let's start from the top again. So this is the website. It's mptrader.com. You go to the trading room when you get in, and it's a diary of what I'm thinking and seeing. Let's see, today's the 18th, so let me just go to the beginning of the day, and I'll just give you a quick thumbnail about that was yesterday. So here it is, good Wednesday morning, and I talked about the rate cut. I happen to think that they were going to do 25 because I thought Powell would be conservative and then tilt dovish for the meeting, and the net result would be the same kerosene injection into the bond market, or I should say into the stock market, or the lowering of rates, the starting of the cycle, and the first rate cut cycle since the pandemic period. But I was wrong, and now there's 50 basis points, and he explained himself either adequately or not during his press conference. And so this morning, I started this one at 9 o'clock. Now, usually I start writing at 8 o'clock, but today I figured I'd take my time. And what I put up was I always start with a big picture or a pretty intermediate term picture of the futures market. And I use futures because basically they trade 24/7, and the patterns associated with a 24/7 market are different than the ones associated with a cash market, or one that trades from, say, 9:30 Eastern time to 4 o'clock Eastern time. So I put that up, and then, this was the equity market going back to December of 23, and I describe it. And I describe it in my text, what I'm seeing. Then I go to the TLT as a proxy for the long-term bond market. 20-year treasuries. Sometimes a lot of times I use the inverse of this or the yield side, but today I decided to use the price side for the bond market. And I described what I see there as being, a significant move down to kill what I think is a major bottom. And that's not finished yet, pushing up into this level. And I think that there's a possibility that if the TLTs go to where I think they could go, 107, 109, that the 10-year yield, benchmark yield, will be somewhere in the 320 percent area. It's been flirting with 360, 370 for the last week or so. Okay, so anytime or whenever I get something I want my members to see, like in this case, it was Roku, which we've been talking about. It's pattern based. My work, I do things sort of the opposite of most traditional analysts on the street. Most traditional analysts on the street hate technical analysis to begin with, but they use it as an afterthought. And after 40 years of doing this, I am more convinced than ever that they have it backwards, that they ought to look at the pattern, psychological patterns that are developing, and then see, overlay, like I do, the fundamentals or the psychology of that particular market or equity or instrument on top of what the chart pattern is telling me. So just to give you an idea of how I think about chart patterns, many of you probably read Malcolm Gladwell's books, and in one of his books, he has different chapters about experts, quote unquote experts in various fields. One expert would happen to be Michael Jordan, who's an expert in winning basketball games and being the greatest basketball player and athlete on the planet. And he didn't get that way just by God-gifted talent, although you could fool me that way. He practiced like crazy, and he practiced 1,000 jump shots in the gym, and over 10,000 hours. Gladwell says the thread through his book is over 10,000 hours. Whether you're a violinist, a basketball player, or a skier, 10,000 hours seems to be the cutoff between you being a quote unquote amateur or not having enough experience to someone who has sufficient experience. Well, I consider myself an expert in deciphering chart patterns and anticipating or interpreting where they might go and where the risks and the rewards are derived from those patterns. So that, in a nutshell, is what I do. In this particular case, I've been bullish Roku for a while based on this potential breakout from this pattern. And sure enough, JP Morgan reiterated an overweight today, and they raised their target price of $90. Well, all along I've had an 82 to 88. So here's JP Morgan up here, and for sure I can see that. But just derived from this base pattern, I could see it getting to 82, 83, and it had a pretty nice day and is on its way. So that's an example of Roku. Here's Apple. Here's my all my hieroglyphics. I do a lot of annotating because there are events that are important. For instance, on the 10th or the 11th, when Jensen Huang of NVIDIA had his talk or made his comments at the Goldman Sachs Technology Conference, the market took off. All the markets took off, not just NVIDIA. That is an event that's pretty much detailed on all my charts. Here's Dell, which that has a pattern that is intriguing, and it's a bull market, big correction, seems to be creating an issue for upside continue. Whoops. I don't know what I just did to my oh, there it is. So it seems to be ready and waiting to take off if it can take out 120. And so there are other subscribers of ours. They come in and they talk about names and issues that they're seeing, put call ratios, VIX, Adobe, This is what I was looking at in Adobe. Someone said, one of the members said he was looking at it and thought 500 was a place where I had commented that people should be looking at for a correction to find support. Now I think that there's a gap left behind in June, an unfilled gap. And now that it's at 500, and I don't think it's finished yet in this down leg off of, close to 600 after earnings. I think that Adobe has some more downside ahead before it will be a potentially excellent buy. Back to futures and then Nvidia, and this is the Nvidia chart. So you get the picture, and it's a running diary of conversations, of thoughts, of charts, of fundamentals, of integration of all sorts of ideas to provide information so traders / investors can make informed decisions about what they should do with their capital. And my final thought this afternoon, after all was said and done, was that Powell poured kerosene on a stock market that is basically was at new all-time highs, which is one of the reasons why I thought he wouldn't do 50 basis points, but so much for that idea. And here is the key, I think. Right now, monetary policy is bullish. Domestic policy, however, is dangerous is uncertain and dangerous ahead of the November election. Geopolitics is a major threat. That's not bullish. And so domestic and geopolitics are not bullish, and they remain the tail risk that could derail the beginning of a new easing cycle. And that's the way we left off today. So now if I go back to my charting package, which is TradeStation. So these are all, each box is a chart. And so if I were to start off somewhere with you, it would be in the cash S&P. So this weekly chart. Okay. So this is a weekly chart of the cash S&P that goes back to like 2012. If I narrow it in here, you can see the low in 2012 and this 2011. This is a massive bull market, as you know, and this is the up leg from the October 2022 low. This is October 2023. This is April 24, and here we are right here now. Now, this is a weekly chart, remember, and we made a new all-time high on the weekly chart today. Yesterday, at 56.70. Now, even though the market closed lower today, I don't see anything on this chart that would lead me to doubt that we're still in a bull market. Now, there are people out there who want to pick a top, and they'll find any excuse to pick a top. Sure, I can tell you that we have non-confirmations in momentum. That momentum peaked here, and here we made a new high, and momentum's lower. I could use that as my main reason for telling you to sell everything and buy puts, and like selling May and go away kind of thing, like selling September and go away. Now, you've probably read that we're in the two starting Monday, which was what, the 16th, are the two most bearish weeks of the year. I think everyone who publishes anything has mentioned that in the last 2 weeks. And that is, I think, 70% of the time since in the last 50 years, and 75% of the time in the last 30 years. The last 2 weeks in September have been down. How much down? I think the blended decline for those two weeks is about 0.8%. So think about that. Everyone is saying, be careful now. And granted, there are outlier years that you're down 10%. There sometimes September's a real disaster and October's even worse. But blended over the last 50 years, we're talking 9.8%. So you have everyone on the street worried about this, and yet the average fallout, as it were, is 0.9%. So let's just say it's 1%, and we're at 56.18 now. So that means we'll go to 55.60 roughly. So if I zoom in on this or out, 55.60. There it is. Keep going. That's right here. So you see where we are now? We're there, and 55.60 is here. So what we're saying is that on average, so let's say you go down to here, on average, you'll end the month at 55.60. Well, that doesn't do any damage to this. For me, to do any damage to this massive bull move, you have to take out these two weekly candles, and and that would start the bull rolling. It's also the 20-week exponential MA, and that level is like 53.90. So until that happens, I'm thinking that weakness in the aftermath of a kind of like sell the news 50 basis point rate hike is a buying opportunity. So there's the equity side of things, and my sense is the next target is 6,000 to 6,100. And could that be before the end of the year? Could it be before the election? I don't know. The election is such a toss-up because you basically have two candidates that not too many people are all excited about. In fact, either you love them or hate them. And I don't know where that leaves us. If everybody was concerned about policy, maybe people would have more of a decision, would be able to come to more of a decision. But if it's a personality contest, that adds a whole new, or keeps a whole new element to it. Who knows what that means? It seems that the Fed rate cut is a cushion against either outcome, because frankly, Harris's tax policies scare Wall Street, and Trump's tariff policies scare Wall Street. So who knows what? But if we're in a declining interest rate cycle, maybe that will ameliorate the damage done by the candidates themselves. Okay, now let's go to the bond market. And unfortunately, I'm running out of time. But anybody has any questions, please don't hesitate. You can reach me at the name of my company is Pattern Analytics. So it's P like Peter, ATTERN ANALYTICS. So it's Pattern Analytics, one word, at gmail.com, and I'd be happy to write you back. Okay, so let me go to my weekly 10-year yield chart for starters, which is here. And here is the beginning, I should say, the end of a 40-year bear market in yield, in 10-year yield. 40 years ago is when I started my career. And they started, this only goes back to the beginning of the 2000s, but they started at like 15.8% and ended at less than 0.5% at the pandemic low. This pattern, I find, is the first leg of a new bull phase in yield. That means that after a 40-year bear market in yield, we started a new bull market, and only the first leg is done. Since last October, coming up to a year, we've been in a correction from 5% into today's low, or yesterday's low, as a matter of fact, was 360. I think we can get into here, into the first quarter, maybe, down to 3.25. And then I think we take off and go into a new up leg. Now, why would we go into a new up leg in yield? Either the economy overheats because of the rate cut cycle, and we've cut 150 basis points by then, let's say, and then the economy really overheats, which is unlikely because lots of people think we're going to go into a recession first. So then what could make yield take off? Now, by take off, I mean take off. So here is the monthly version of the 10-year yield chart that goes back to 1985, and then yield was 13% back there. So this version of the chart, this monthly chart, this is the low, 40-year low, maybe 42-year low. And this is the end of the first up leg. And this is the pullback. And the symmetry of this looks like a massive, massive base that has much higher objectives. Like, I mean, much higher. Now, what would happen? What would have to happen for those crazy yields to happen? Well, I think that the answer, or one of the answers, could be right here. And that's the US dollar. Now, the US dollar took a hit today, and this is a 20-year chart, a weekly dollar index chart. And it looks to me like it made a major peak in September of 22, 2 years ago. And it's in a bear phase now, and it's just starting to break down or get to the point where it could break down in a very big way. And if it breaks down, it will be symptomatic of other things. And what those other things that are bothering me is no matter which candidate wins, it's only a matter of degree how much they both, either of them blows out the deficit even more. Now, when you have a $2.5 trillion annual budget deficit lopped on to a 35 or $36 trillion debt, listen, for my entire career, people have been telling me or suggesting that this is it. This can't go any higher. Well, I don't know whether it can go any higher or not, but I think both these candidates are going to spend so much money, and the Fed is not going to be able to counteract the spending. Now, if it turns out that we have a recession, spending is going to crank up even more. So the deficit side of things is just going to blow out totally because of fiscal spending. If the economy responds to the rate cuts and we go from the Atlanta Fed's 3% growth to let's say 4.5% growth, and productivity rips to the upside because of artificial intelligence, et cetera, et cetera. Then you have an overheating economy, and there's no way that the government is going to reduce spending in that. It will be up to the Fed to ratchet up rates. The bond market, however, the vigilantes will be out in force. And that's where these people come in that are going to rip this back to 5% and above. And on a pattern basis, if it gets back above 5.25, this pattern suggests we have something is going to happen that is going to just make us like deer in the headlights, that rates are going to back up for some reason. I don't know what. Okay. It's like, I don't sit around dreaming up reasons for this. All I know is that until my chart work tells me that I am way off base, or, that something broke that invalidates my thought process, I have so much faith in what I've been doing for the last 40 some odd years that I can't afford to doubt myself until my chart work tells me, Mike, it's over. That scenario is out. Okay, so let's just go over a couple of other things today. So the metals, this is the FCX chart. Now, FCX has motored up from like under 40 to 45 almost today. It looks to me like FCX has finished the correction, and for some reason or several reasons, mostly to do with a lower dollar and declining an accommodative rate cycle. FCX now may be in its element, and this whole setup is telling me that if FCX can, take out this 47 area, it's going to 60, and that is an oil, which is nothing to speak of at the moment. That's not helping FCX. Gold and silver or copper is just starting to turn back up. Now, I don't have enough. I didn't put the chart here for this presentation, but um, copper prices, or China, I should say, based on the YINN, the yin ETFs, you should take a look at that because it looks like it's trying to bottom. And I wonder if that's indicative of China reasserting itself. And if that happens, then that plays into FCX, etc. Okay, let's just look at arguably the only more important setup or influence on the planet than the Fed, and that might be Nvidia. Okay, now Nvidia, arguably, when Jensen Huang says something, it's more important than what Powell says. And I don't think too many people can say that about anyone else. So it looks to me like all of the action since the June high is a bullish coil. It's pretty much above this plateau. And as long as that's the case, I think Nvidia has a chance to go much higher, 150, 160. And I think that over the next week or so, it will play itself out. Earnings are on November 27th, so that's after the election. But nonetheless, I think that Nvidia has some big upside ahead of it. And if it gets into, the closer it gets to 100, 102, the more significant buying opportunity I think it'll have. Okay, so what else I want to show you? Silver, Tesla. Oh no, SLB. SLB in the oil sector. So this is, I find this pretty interesting. SLB has developed or integrated an AI program to help it become more efficient. Now, oil prices aren't helping SLB, nor are they helping anyone else or any other company in the oil patch. But if it can make these companies more efficient on the back end, then the bottom line will show the difference. And it looks to me like this is pandemic low 2020. This is the 2023 September 2023 high, first bull leg over. Major correction, September of 23 to September of 24. And it looks to me like this is over. And that SLB, of course, it hasn't done enough to trigger a buy signal yet, but I'm watching this carefully now. It looks to me like anytime it flirts with 40, 39, holds, pops back up to 42, it will be telling us that it's doing one of these, or one of these, or even one of these. But this is a correction that looks like it's complete or nearly complete. And if so, then Schlumberger on the bottom line will show great results because of its AI integration. And if oil prices start to creep back up to 75, 80, and their business picks up, and I realize they're not drillers, but their business picks up in general, then this thing I think is headed for a new upleg. Okay, I have 1 minute left. Let's see, what was this? Apple. All right, that's a nice place to end. Okay, so Apple, well, it looks to me like Apple's July, August to August 5th. This was the yen carry trade low period. I think it started a new bull leg. This is the end of the first up move of the new bull leg. I think probably after today, there's a little mystery that instead of retesting this lower level near the trend line, it took off And if you can get above 222 and sustain above 222, there's a pretty good chance that Apple's going to take off. And with all the latest buzz, not about the iPhone, but about the ear pods being, you know, audio devices for the hard of hearing. And, there's probably 100 million Americans that need, earpieces. And now they can use the iPods, iPuds for that. And in addition to that, the all the AI integration, I think Apple could be the big surprise, regardless of whether the iPhone has relatively weak demand initially. Anyway, I think my time's up.
All right, everyone, that concludes our time for this session. Thank you all again for joining us, and thank you, Michael, for your presentation. Please be
Thanks a
sure to
lot.
stay tuned as we have more in store for you later this week.